Why is trading indices so profitable next to forex trading? When forex pairs are slow, indices can give you the profits you need. But for most traders, trading indices is quite confusing. But trading indices alone got me profitable. In this video, I'm going to walk you through step by step how to trade indices to make money. To do this, first I'm going to show you what the different indices are. With this foundation, I will show you how to make money with them. And after that, I will help you understand how you can use the economic calendar, the red folders, to get even better results. So let's get into it.
In this video, the first thing we're going to discuss is what are indices. Then we'll go over the three biggest indices, the NASDAQ, the S&P, and the Dow Jones. And of course, the most important one, how to trade them. Sources are from both Investopia and Barchart. So shout out to them to providing some nice information. What are the index futures? Index futures are contracts to buy or sell a financial index at a set price today and are settled in the future. These contracts were initially meant only for the big boys, for the institutional investors, but have been opened for decades to anyone. So what we do basically, we say today we think, for example, NASDAQ is worth 20,000, and in the future we probably say it's going to be 21,000. So we're setting for the future. Portfolio managers use index futures to hedge their equity positions against a loss in stocks. Speculators, that is us, can also use index futures to bet on the market direction. This is what we do. Most popular index futures are the NASDAQ, the S&P, and the Dow Jones. Those are all US based, so America based. You also have non-US futures, for example, the German DAX, the English one, the UK one, the FTSE, and the Japanese one, the Nikkei. In this video, we're mainly focusing on, let's talk about the NASDAQ. The NASDAQ is the top 100 companies in the US, and mostly they are tech companies. And the top 10 companies you already see is Apple, Microsoft, Nvidia, Amazon. I think you recognize them. And here, if you see the sectors, and you see 62% of the whole NASDAQ is technology, then consumer, then healthcare, but mainly said. You can just remember that the NASDAQ is just the tech companies. So that means when tech companies rise, like for example, recently at the time of the recording is 2024, Nvidia had like a massive run. The NASDAQ is just shooting up. At the same time, when rates are high, when the economy is slowing down, when big capital is harder to grab for investors, you see tech companies having a rough few months, and you see the NASDAQ declining as well. Then the S&P. In the futures, S&P is also ES. So if I refer to ES, I mean the S&P 500. The S&P 500 is the top 500 companies in the US, with many similarities to the NASDAQ, but there are more companies and it's balanced through more sectors. So you see again, Microsoft, Nvidia, Apple. You see most of the tech companies in there, but you also see Berkshire Hathaway, insurance and investing, JP Morgan, bank, ExxonMobil. So a little different. And you see here only 33% against 62% on technology in S&P, financials, healthcare. So a little different composition. What you can already remember from the S&P and NQ is that they move the same. So in general, you see when the S&P rises, NASDAQ rises, and vice versa. Then the Dow Jones. The Dow Jones it's composed of 30 videos, and we also call it YM. That's the ticker. So where the S&P had ES, where NASDAQ has NQ, Dow Jones has YM. And 30 companies. You see them all 30 on the screen. You don't need to remember what 30 there are. You just need to know that there are 30 companies, like with some similarities, but also some difference between the NQ and ES. For example, Boeing, Chevron, the Dow itself, IBM, McDonald's. And the difference between the Dow Jones and, for example, the S&P and the Dow Jones are the two most watched stock indexes in the US, indices. However, these two are benchmarked very differently. The Dow Jones tracks the 30 large cap stocks, while the S&P tracks the largest 500 stocks. That is already a difference, 500 against 30. The Dow Jones index is price weight, while the S&P 500 is market cap weight. So the price of the Dow Jones is based on the price of the stocks. The S&P is based on the market cap of the individual stocks. So what it's worth. And also how the specific stocks are inside the indice. In the Dow Jones, they are chosen by a committee. And on the S&P 500, they are added according to a formula. So if your company gets bigger and bigger, eventually you will get into the S&P 500 based on the formula they are used. And if you want to be in the Dow Jones, you need to be chosen by a committee. Again, guys, this is all theory. For your actual trading, you don't need this information, but it's nice to have some background information of the specific asset class you are trading. Now let's go into the more juicy stuff of the video. And that's how to trade the indices. We're going over index contracts, we're going over TradingView, we're going over their movements, and also we're going about news. So when to trade them, where's nice volatility. And the starting point of future contracts is Barchart.com, very important website when you're going to trade futures. Barchart.com, go on top to futures and then press indices. There's where you want to be. Index futures Index future contracts allow investors to make trades on various indices based on their predictions about the overall price movement of the particular index. In other words, we as traders speculate on a daily basis or weekly basis if we think price is going up and we go long, or we think price is going down and we short. Future contracts involve margin. Margin means leverage, and leverage means that investors and traders can trade much larger amounts of money than their actual available capital. And that's very nice. That means if you're trading with a 1 to 100 margin, that means if you have $1,000 in your capital, then you can play with times 100. So you can play with $100,000. More about leverage in a later part of this beginner bootcamp. So when you get the bar chart and you press futures indices, you will see this little schematic. And I want your eyes to go towards the volume tab right here. And why? Every 3 months, a new contract goes live. So that means in March, we have a contract. In June, we have a contract. In September, we have a contract. And also in December, their specific tickers are H for March, M for June, September for U, and Z for December. For March, it's an H. For June, the ticker is M, September is U, and December is Z. So you will see here, the time of the recording is July 2024. So you see the volume is very high right here at the ESU 24. That means ES is the S&P, U is September contract, and 2024. So S&P September 2024 contract is live right now. Later this year, the December contract, so after September, this December contract will go live, and then we have ESZ 2024. And you will see in your chart, when your contract is expiring, you will see the bodies of the candle being a little blurry, not complete anymore. And you will know, okay, now I need to change towards a new contract, or just know every 3 months, just roll. It's called a rollover of the contract. Then you go from the September to December. After December, you're going back to March. Same for NQ, for example. 106 is a lot of volume. NQU, so NASDAQ, September 2024. Every trader uses TradingView as their main tool of analysis. And when you want to trade the index futures on TradingView, by default, you will see this S&P 500 futures, and then you will see this orange D appearing. And it says ES data, and this example is S&P. ES data is delayed by 10 minutes. To get real-time data, please buy the real-time data. So if you want to see the future data without any delay, without any 10-minute delay, you have to get CME data on TradingView. It's a few dollars per month. You can get it on tradingview.com/CME. And I can understand that you are just dipping your toes into futures. You don't want to pay any extra. And until you're actually trading futures, you're going to take your trade with your money. You can use the free ones. It's US 100, US 500, and US 30. The only difference is the numbers. And also the price action can be different sometimes. And what I mean by that is, for example, on the futures contract, we have lower highs, lower lows, downtrend, and sometimes we have an explosive move upwards. So we had one more sweep of this low, made one more lower low before the real move upwards. What sometimes happens is the future contract on the free one, what you will see is same lower lows, lower highs, but without that lower low being made, the move's already done. And if in your trade plan, what you're going to make, one of the things you want to see is that sweep of liquidity, that one more lower low being formed before the real move, you were not in this move just based on the fact that you didn't have the real-time CME data. This happens sometimes. So that's why I highly recommend when you're going to trade the indices, go use CME data. And now let's hop into TradingView to see how you can trade the indices in real time. Now we're looking at TradingView at the NQU 2024. That means the NASDAQ September contract from 2024. And the same is for ESU, YMU, and it's the CME data. You can also go for the free one. So for example, you want to have the free one of US 100. There we go, US 100 from capital.com daily. And this is same chart from NASDAQ. And you can see it here already, the example I gave in the slide. You've seen the Dow movement, right, for the last few days. But look at the low here, the Monday 24 low right here. US 100 did not take this yet, but here the future contract did. So if you want to, for example, take a long position from this point, if in your trade plan says the low, there needs to be a lower low before I take the trade. If you don't have the paid data, you won't have the information. Also, what's different here, you see the numbers. It's currently 19,730, currently 19,713, and here it's 19,519. The numbers are not the biggest problem. It's the problem in the price section with the highs and lows. So keep this in mind while choosing if you want to get the CME data or not. And again, I would recommend to get that few bucks a month data. Now you know about the future contracts and about TradingView. we're going to talk about the basics of how indices move. And what you should remember is the indices rise slowly and fall quickly. A nice quote from this is the bulls, so the buyers come with the stairs and the bears jump out of the window. Bears are the sellers. You see staircase upwards, little upwards, higher highs, higher lows. And then when indices fall, they fall very quickly. But know that over time, since they exist, they have been going upwards. And a very important note here, for day trading, it does not matter if you're going long or short based on a long-term trend. You know indices will go up over time. But you can go long, you can go short, and the amount of up days, so green days, and red days, down days on specific indices are around 50-50. But over time, you will see that the green candles are bigger than the red candles. So over time, the trend will go up. And at last, talk about news. Very important in your trading. The indices are a fraction of the stock market. When economic conditions are good, the specific indice will go up. Vice versa, when the economy is very bad, you will see the indices falling. Important news indicators. First is GDP, the bought goods and services. NFP, the job growth over time. Interest rates. When you have low interest rates, you will see the market going up and vice versa. And important are company earnings. So for example, when Nvidia has amazing earnings, they made a lot of profits, made lots of money, you will see that it has a positive impact on a specific indice. Nvidia is a tech stock, so the NASDAQ will most likely go up. Thank you for watching this video. In this video, we first went over what indices are. We went over the NASDAQ, NQ, and YM. Then we went over the futures contract, the change of the contracts every 4 months with their specific ticker, and you can find it all on Barchart. We went over TradingView. You should make the decision if you want to use the CME data, yes or no. We went over the movements, that the bulls come with the stair and the bears jump out the window. And we went over the importance of news with trading indices. This should be enough to be your starting point of trading indices. If you like this kind of videos, please like and subscribe, share with all your trading friends, and I'll see you in the next one.